In terms of the like, I just want to go over the response. They supported all unsecured depositors, so anyone who had funds over the 250K cap. They're now saying they're fully covered, right? They're going to get all their money back. And then the new emergency Fed facility provides liquidity for banks that come under similar pressure. The Bank Term Funding Program. It's just another acronym they came out with. And like you said, it provides loans. Basically undersecured and cheap loans. They can take their bonds that are underwater, like Joe was saying, that had suffered from all this interest rate risk, and use them as collateral with the Fed valuing them at par. And that's kind of the bailout, if you will. There's no fees, there's no prepayment penalties associated with these loans. Any of these banks that now have underwater bonds, if they ever come under pressure where depositors want to withdraw their funds, they can go to this facility and say, hey, we need a loan, and they can give their underwater bonds to them, and they'll get that loan with the collateral at par. So a lot of people are arguing, though, because they're saying, well, this isn't a bailout because, the equity shareholders were wiped out, the bond holders were wiped out. And so, Joe, do you consider this a bailout? And because they're saying taxpayers won't pay for it too. And that's the big argument right now.
Yeah, so I tweeted yesterday, this is QE5. This is QE5. And people in my comment section, they may take me as financially illiterate for saying that, but I want to explain why I'm saying it's QE5, somewhat in jest. But I do agree with you that it's a bailout. The Fed does repo operations all the time, right? The Fed has a standing repo facility. They take in treasury collateral all the time, and they pay out cash, right? They do this all the time. They do this on overnight with their standing repo facility and their reverse repo facility, right? When you move in the inverse direction, you could park excess cash. You get a treasury in return, then they buy that treasury back from you at the next day for a slightly higher price. But the difference with this is that this is not a normal repo operation whereby a bank puts up treasuries as collateral and can receive cash in a short term loan. This new emergency discount window, essentially, you can take your distressed collateral, right? So collateral that is deeply discounted, right? All these treasury securities, all these banks that have unrealized losses over the last year, from obviously the worst year for treasuries ever, I believe, and they can bring them to the Fed and redeem them at par. And so you're creating dollars where there weren't dollars before. You're flooding new value into the system, right? And enabling more credit creation on behalf of these banks, which is inflationary, right? By lending against these deeply discounted assets at par, right? I'm J.P. Morgan. I go to the Fed with my 30-year long bond trading at 50 cents on the dollar, and I borrow $1 against that, right? And so all of a sudden, I no longer have that discounted asset. I now have what was 2 times the value of that asset on my books, and I can go out and create credit to the tune of that. And so that's a bailout. It's essentially a bailout, through essentially removing and making all of the requirements to go to the Fed's discount window extremely lenient, and then also saying that, hey, we will lend against all of your collateral at par, rather than saying we'll lend against your collateral, plus 5%, plus 10%, or at market price. That's basically a bailout because you're introducing new value into the system where there wasn't any value before. And frankly, this is the most nonsensical Fed response for a Fed that has played it pretty intelligently throughout this whole cycle. And I'll say that I'll give the Fed credit, right? They've stuck to their guns. They've effectively managed expectations ahead of time. This is one of the most nonsensical things that they've done, right? Through not allowing this creative destruction, as you put it, Sam, and as Austrian economists put it, to play out. They're essentially letting this poorly allocated capital proliferate. They're kicking the eventuality of having these individuals default down the road, and saying that it would be systemically disruptive if they defaulted. Which seems patently false, right? If Silicon Valley Bank was as small as it was, and it had an extremely small loan book, remember, they had a very, very large securities portfolio relative to their loan book. If they defaulted on their loan book as the 18th largest bank with an extremely small amount of loans outstanding, I don't think that would have been systemically disruptive. I think this was the Fed. This was a Fed who made a huge policy error here, and I think that The reason you see treasuries getting bid up so hard, particularly on the front end, is because people are saying, "Look, this was indicative. You guys are done here. You guys blinked. It doesn't seem as of right now that and what this essentially did was it showed that the Fed is fearful, and that's not what you want as an individual. The reason the Fed has been so successful this cycle in what it intends to do, which is wind down its balance sheet, remove bank reserves from the system, while also hiking its policy rate. The reason it's been so successful is because the public has seen the Fed as being in control and having its hand on the steering wheel. And with its emergency actions yesterday, that in my opinion didn't need to happen, it shows to the public, to the rates market, and to every single market that the Fed perhaps wasn't as in control as was previously suspected. There's a little bit of fear on behalf of the Fed, and therefore it's going to have a tough time transmitting policy, and it's going to have a tough time being taken seriously if at the March meeting it says we're going to continue being tight with policy, because you basically just showed that you were bluffing, and indicated that there was, what you believed systemic credit risk in the system, which I don't feel that there was. I think this was a systemic policy error. And because, the Fed's response is, of course, redeeming this distressed collateral at par, that's essentially, introducing new value into the system. That's a bailout, right? Whatever way you want to call it. And that's why on Twitter, despite it not being entirely accurate, I called it QE5.
Yeah, and it kind of rubs me the wrong way when they say taxpayers won't pay for it because, although it's almost like a bailout from big banks to small banks in a way, and the fund is going to the depositors, but it's paid by these U.S. banks, but it's ultimately backstopped by the Treasury Exchange Stabilization Fund, and therefore the U.S. taxpayers. And the Fed facility, it's going to exchange all this underwater bonds, all this paper at par with no penalty. And it's all going to go on their balance sheet, right? That's what Dylan was just talking about. All those losses are now on the Fed's balance sheet. So, the taxpayer will pay for it ultimately. But they're saying, hey, this isn't the global financial crisis. We're not bailing out equity holders. We're not bailing out bond holders. These are depositors. But, the same thing. It always goes back to the taxpayer. And it's not right, in my opinion. And I agree with you, Joe. I don't know if it would have been systemic, but that's what they're saying, and that's how they're getting away with it,
And it's
right?
pretty remarkable
Uh,
because allowing this particular bank to fail, just to interject, it would have helped them in what they're trying to achieve. What has the Fed said since day one, right? What has Jerome Powell been upset with? He's been upset with the fact that you can bid monkey JPEGs, that these things are trading 1000x over the weekend, right? He's upset at all of this poorly allocated capital. And so allowing a bank to fail that services VCs and services tech firms and services these crypto firms, allowing that bank to fail, that helps the Fed in its policy mission to vaporize this poorly allocated capital. So allowing it to fail, it goes with the Fed's mission. But for whatever reason, the Fed decided to blink. The Fed decided to bail them out. And so that just makes it all the more
yeah.
silly.
Yeah, man, you're exactly right, man. I agree completely. And it's interesting too because there's some thoughts around the fact that this facility, now that they basically removed interest rate risk for all these banks, right? I mean, is this really a way for them to continue raising rates higher, do you think? Like they can basically get away with it because, like, all right, we're not going to blow up these banks because we have this, facility now in place, and they can just always get those bonds valued at par no matter how high we jack rates, so we can keep fighting inflation. Do you guys sympathize with that view at all?
There's a couple interesting takeaways. The first is that I believe there's a date. I think it's like December, where there you can no longer purchase those long duration securities and pledge them in this facility. At least, could that change? Of course, it could. But it doesn't. You can't go load up on duration right now and then see a big drawdown and not have take that risk. It's just for kind of the lag and all the securities purchased post in 2020 and 2021 essentially. Um, and so I think that's part of it. The rates market, the STIR market, short term interest rate market, is pricing in a total pivot across the board. At least a, a a pause or a kind of rejection of the higher for longer, and saying, hey, maybe they don't even hike this next March meeting, and then they're going to hold, and then they're going to cut 50 basis points, 100 basis points in 2024. I think there's the potential with this facility in place, some regional bank consolidation. The fortress banks aren't gonna face these same worries. At least I don't think so. That would be quite the phenomenon if they did, but they don't have that much exposure to duration. And so I think this does, if CPI continues to rip, the labor market's still super, super tight. Core inflation is stickier than I think a lot of people would like to believe, even with this, the lag effects of the tightening cycle underway. I think they I'm not in the camp where I believe they go to the zero lower bound right away, and immediately have to turn on the money spigot in full force as they did post COVID, right? Maybe some bank liquidity dynamics to take care of, but the rates that are 4%, maybe 5%, I think there could be some repricing in the next couple weeks here as we get the CPI print, as we get some more economic data that says, okay, now that we've had this banking scare, I think we could see this not as high as they thought for the higher for longer, but the immediate knee jerk pivot reaction up only, Fed capitulated, might get walked back a bit, and so that's more for the short to intermediate time frame traders. Like for the Bitcoiners, and I'm sympathetic with this view because I'm partially in this camp. Like I have an active portfolio for more short term stuff. I also have a decade, century hodl bag that I don't care about. You know what I mean? Like that I'm just accumulating Bitcoin because I know this end game. So I certainly sympathize with that view of like, okay, who cares whether the next Fed meeting is 50 bips or 25 bips or 0 bips? This train has no brakes. It's teetering off the rails. Has it teetered yet fully or not? Who knows? But it's coming. And the end game is as inevitable as it ever was. I certainly sympathize with that view as well, and tuning out all that noise and just stacking. So yeah,
Totally.
yeah, we'll see.